And futures pointing to a lower open today. What should investors keep in mind now that the Federal Reserve has raised rates and signaled a more aggressive pace of rate hikes? Michael Lee at Investmark Advisory Group joins us now. Good morning, Michael. Good to see you. So this is so interesting. The Fed doing exactly what we expected, right? Instituting a quarter-point rate hike. But their forecast for GDP growth of inflation higher than they were in the last meeting, lower unemployment breaking below 4% with a 3 handle. What should investors make of this aggressive new Fed?
Well, I think the first thing that people need to keep in mind is the reason they're raising interest rates. And the reason they're raising interest rates is because the economy is getting stronger. And the economy getting stronger is good for the underlying stock market. I would make the argument that interest rates have been far too low for too long, and that this path to normalization to where interest rates, the Fed funds rate, short-term rates get somewhere in line with GDP is going to be stimulative. Why is that? That's because savers are going to make a little bit more money in their whether it be their checking account, their savings account, or their short-term bonds. And also, the net interest margins of banks are going to start going through the roof. This allows them to lend more money and make more money on loans, allowing them to take more risk, increasing the flow of capital to our economy. So I think these next, 4 to 5 to 6 rate raises from the Fed are going to be stimulative for the economy. I think it's going to be. I think it's going to introduce a lot more volatility in addition to what we've already seen.
All right, so good for investors, that's what you're saying, and certainly good for savers if we get 2 more rate hikes this year, 3 more next year, and they're projecting out into 2020 more rate hikes. Are there any other benefits you want to mention?
That we're so far away from slowing down the economy in terms of the interest rates, right? We need to be above GDP on the short end, so maybe 8 or 9 rate raises from here to where we're actually going to be in a restrictive stance. So I think any weakness is a nice buying opportunity for individuals that have cash on the sidelines.
Well, I got to tell you, one thing that could slow this market down, this economy down, a trade war, and as we know, we've been talking about it all morning, China prepping retaliatory trade measures. They're talking about putting some kind of tariff on American farmers, soybean producers, hog producers, and of course, it's a big source of Trump support. Some people out there are saying that, look, at the end of the day, this could mean that there are 2 coalitions, one supporting China, countries supporting China, the other supporting us. What would be the impact of that on the markets?
So I think these tariffs and these short-term trade spats are short-term pain for long-term gain. The U.S. is the freest and fairest trader in the world. And so if we start slapping tariffs on other countries, I believe it's a negotiating stance to get better deals for our exporters. You don't want to get in a trade war with the United States. It's like me getting in a boxing match with Mike Tyson. I might get a shot in, but it's an inevitable that he's going to knock me out very quickly. I mean, our imports would be the 3rd or 4th largest GDP in the world, and our trade deficit would be the 6th or 7th. So we're an import country, and anybody that wants to kind of dance with us is going to feel it a lot more than we are. So that could be a short-term negative, but I think it's a long-term positive.
Net import country with, the richest consumers in the world, really. Michael, thanks for coming on. Appreciate it.
Perfect. Thanks.